So, if you're into growth investing, you've probably heard the term G score thrown around, right? But what does it actually mean? There's a surprising amount of confusion out there. Well, today we're going to clear all that up. We'll show you exactly how this powerful tool can help you tell the difference between a company with real, sustainable growth and one that's just riding a wave of market hype. Let's dive in. Okay, so you've probably seen this name, G Factor. And honestly, this is where the confusion really kicks in. Are the G Factor and the G score the same thing? Not exactly. The answer is a little more complicated than a simple yes or no, and to really get it, we need to start with the basics. See, at a basic level, a G factor is just a general term for any score that helps you find growth stocks. You know, those companies that look like they're ready to grow way faster than the market average. It's a really useful idea. But the problem is that same name gets slapped onto a few different tools. And that brings us to our first big point. This is really a tale of two different scores that just happen to have almost the same name. Getting this part right is the key to understanding the whole thing. Okay, this is where it all clicks into place. On one hand, you have the G factor you might see on a stock screener website. It's great for what it is, a quick, simple tool for an initial screen, usually focused on short-term results. But on the other hand, you have the academic, much more robust G-score that was developed by Professor Partha Mohanram. This one is all about a deep, fundamental analysis of long-term, sustainable growth. So for the rest of our time here, when we say G-score, we are talking about this one, the deep dive academic G-score. All right, so let's officially meet the real G-score. And this isn't just some quick number you glance at. Think of it more like a really sophisticated framework, a test to check the quality of a company's growth, not just the speed. And what's amazing is that this whole powerful framework, it all boils down to just one number, 8. Yep, the entire G-score is built on just 8 specific targeted questions. No crazy complex algorithms, just 8 straightforward tests that a company either passes or fails. So what are those 8 questions? How does this thing actually work? Well, it's time to pop the hood and look inside the engine room to see what makes it tick. Now, these 8 tests aren't just a random checklist. They're neatly organized into 3 main categories, or you could call them pillars. Think of it like a complete health checkup for a company. Pillar 1, is it actually making money? You know, profitability. Pillar 2, is that growth steady and reliable, or is it all over the place? And Pillar 3, is the company playing the long game, investing in its own future? So let's break down that first pillar. Profitability. A company gets a point if its earnings per share are growing. Simple enough. Then, it checks if the company's return on assets, basically how good it is at making money with the stuff it owns, is better than its direct competitors. And then, and this is crucial, it checks if the actual cash flow is stronger than that on-paper ROA number. And that last part is so smart. It's asking, is the real cash coming in the door stronger than the accounting profit? This weeds out companies that look good on a spreadsheet but don't have the cash to back it up. Okay, pillar number 2, growth stability. See, it's not just about how fast you grow, it's about how smooth that growth is. The G-score actually gives a point if a company's earnings are less volatile than its peers. It does the same thing for sales. It rewards predictable, steady growth over those wild up and down swings. Why? Because those swings can be a huge red flag, a sign of a really fragile business. And finally, we have pillar 3, what's called accounting conservatism. And this one is my favorite. It's actually fascinating. The score gives points to companies that spend more on things like R&D and new equipment, that's CapEx, than their peers. That makes sense, right? It shows they're investing in the future. But here's the twist. Look at that last one. It actually rewards lower advertising spending. And you might be thinking, wait, what? Well, think about it. Really high ad spending can just be a company trying to buy short-term sales. A truly great company with a fantastic product often doesn't need to shout that loud. The growth is more organic. Okay, that's a lot of theory. It's interesting, but how does this actually work in practice? Let's put this score into action and see what happens.
We'll take a hypothetical tech company and run it through all 8 of these tests to see how it does.
All right, so here you can see the scorecard for our company. Let's just pick out a couple of examples. It gets a 1, a pass, because its return on assets is higher than its competitors. That's a good sign. But, look here. It gets a 0 for sales variability. That means its sales numbers are way more jumpy than others in its industry, so no point there. You just go down the list like this, one by one. Pass or fail, 1 or 0.
So, when you add up all those ones and zeros, our tech company lands on a final G-score of 6. Now, what does that mean? Well, based on the original research, any score between 6 and 8 is considered a really strong, high-quality growth stock. On the flip side, if you get a score down in the 0 to 2 range, that's a potential red flag, what was called a falling star.
And all of this brings us back to the entire point of the G-score. It's a tool that helps you make one of the most critical distinctions you can make as an investor.
Really, it all comes down to this one idea. A company might have an amazing story, a ton of buzz, a stock price that's shooting for the moon. But the G-score doesn't care about any of that. It's like an X-ray that cuts right through the hype and forces you to ask that crucial question. Is this growth the real deal, built on a solid foundation? Or is it just a house of cards, propped up by risky finances and a good story? So the next time you're looking at one of those exciting, high-flying growth stocks, just pause for a second. Think about these 3 pillars: profitability, stability, and that smart investment in the future. It is such a powerful mental model to have. It leaves you with one big question to ask yourself: what's the real growth story behind the stocks that you're following?